Hello, everyone. Thanks for joining us up here. I think the room was empty a minute ago, lads, so they've all come in to come and watch you. Bit of a crowd chaos to get in the room, standing room only. Thanks for joining us. We're going to have a bit of a panel discussion now about traditional finance, tradfi, has been mentioned a few times today, and whether it's embracing DeFi, what that means, what DeFi actually is. And then just have a little bit of a discussion about where do we think the industry's going, what are the impediments for growth at the moment. I'm just going to start off quickly with a show of hands. How many people in here currently or have previously worked in a tradfi job? Nice. And the same question for DeFi roles. Yeah, nice. And anyone done both? Yeah, there's a few less hands there. Excellent. Can you all come up here? Anyone who's got both hands up, you can come and help us run the panel for it. Brilliant. Okay, so I might just start off a few introductions so that you know who's up here talking at you. I'll start with myself, Ben Radclyffe. I currently work for a firm called Amber Group. We're a financial services firm. We do a bunch of different things, but OTC brokerage, we do some trading, run an asset management firm. We've got some private wealth management, DeFi style apps as well. It's a very crypto native company. And previously ran an exchange and a high frequency trading firm. Got into crypto, and then before that, I'm like 20 years worth of proper tradfi experience, which is why I look so bored from that experience. I'll hand over. We've got T from the LSE, Alex from Names, Rob from Bitrue, and other Rob from Appold. I'll just pass down and ask you quickly to introduce yourselves, give a couple of lines about your firms, and we can kick off from there.
Shall I go?
Start lucky.
Okay. Yeah, hello everyone. My name is Rob Gaskell. I work for a company called Appold. Appold is an independent blockchain advisory company. We work with institutions that are looking to use blockchain technology, as well as companies like protocols and blockchains themselves, and also companies in the digital asset space who are trying to bridge the divide and come across and work with institutions.
Thanks, Rob. I'm Alex. I'm head of product at Names. Names is a digital insurance company that is made up of a marketplace of tokenized insurance programs, which allows capital markets to invest in subsections of our balance sheet.
Hi guys, Thamim here from the LSE, head up the research lab there. We typically work with regulators, central banks, a lot of the tradfi crowd, sort of educating them on what is this phenomenon of the blockchain technology. We're usually seen as the cheap consultants before they go off to PwC or anybody else. No offense to the PwC consultants here. Other than that, sort of work very closely with layer one protocols on how we can bring adoption from the innovation side of research into the protocols.
I'm Rob, Chief Strategy Officer at Bitrue, which is an Asian and European focused exchange. It's probably one of the biggest ones you've never heard of, so it's 9th by trade volume on market cap on most given days. I've worked in both traditional finance and obviously now not in traditional finance, so I sort of have I lean towards both. I think they both have their benefits and downsides, so we'll get into that today, but yeah, so that's me.
Cool, thanks guys. Yeah, good place to start maybe is we pass over to the educator down the end to just discuss or tell us a little bit what when you think about DeFi and tradfi, where does the line get drawn? What's the background of both? And just give us a sort of scene setting discussion about what we're talking about here on the panel.
Try my best. So when I sort of think about tradfi, the first image that comes to mind is many of you sort of familiar with the concept of the money tree, sort of M0, M1, M2, M3 sort of layers of money or payment systems. Where M0 money is sort of central banking money, and then you have wholesale banking money, retail banking money, and then the various different layers that's on top of that. And around that sort of money tree, you have payment systems, or traditional payment systems that execute orders between the different layers. And then on the other sort of spectrum, you have DeFi, which is all sort of open source, smart contract driven, and sort of the whole new innovation of the cryptocurrency side of the payment system that's sort of come in. I'll talk a little bit more sort of on the DeFi side, and maybe I can kick it off with a good sort of example or comparison which people can think about. So in the TradFi system, let's just talk about a stock market where typically it's an open market, but not necessarily accessible. So anybody can go and trade, but you have to go through various different sort of processes to get access to the marketplace. Whereas on the DeFi side, you can have a trading platform, anybody can open and access, and essentially a 15-year-old could be trading against a Wall Street sort of banker. So the key sort of differences are between DeFi and sort of TradFi, in my imagination, is the level of access that it can provide. And sort of what's happened so far in DeFi, I guess, since the promise of blockchain applications is mainly you can do 2 or 3 things. You can trade on DeFi sort of platforms. You can do another bit of innovation is yield-bearing sort of products on a decentralized sort of financial sort of platform, whereby the underlying protocol token can also act as a liquidity mining or attraction tool for the platform itself. What this means is many sort of platforms are able to create and attract new users, which can be a moat for that platform, which is very different to existing traditional sort of financial systems. And finally, you can sort of borrow, lend, and trade, borrow and lend on these platforms. So that's where, so I guess, DeFi is right now. The primitives, it's not really sort of scaled beyond that. So I can probably sort of leave it there, and then we can talk about, where are some of the emerging trends.
Thanks, sir. Anyone else got anything to add quickly to that? Amusing anecdotes that, when you're describing it to your children, you can lob in an example? Excellent, all right. So I think one thing that I just wanted to add on, I sat in a few of the prior panels and watched them. So we had one which was about institutions, which I suppose is a little bit like TradFi, coming into crypto specifically. And then another one about regulation, which focused a little bit on DeFi, but mainly actually on like the sort of CeFi trading side of things. I think for this, one thing that's worth pointing out is that DeFi products themselves aren't always just about cryptocurrencies, but there's plenty of other things that you can have in there. So like the tokenization of assets, for example, or products and services that exist now in code rather than going to a big company. So we're lucky enough to have somebody, a practitioner up here that works in it. So I thought, would you mind going through like what your company does and sort of some real life examples of a financial instrument that now exists in DeFi that isn't necessarily about trading? Alex.
Yeah, sure. So, we had, there was a panel earlier today, I think, about tokenized real-world assets too, but, to give a little flavor to what we do at Names with a specific example, we have an example. So I mentioned tokenized insurance pools. Specifically, one example we have is an industry loss warranty program. This is like a reinsurance contract that basically protects against, in this specific case, like hurricane damage at a industry level. So you basically pick a threshold, and it allows the insured to gain cover, if they have exposure to hurricane damage somewhere. And what we do at Names is we tokenize the pool, so the capital that comes in is exchanged for a participation token. And what that means, in the benefits of tokenization, there are a couple-fold. One is, you have this instant verifiable data of like who owns what, and it means that, when you add smart contracts to the mix, you can programmatically pay out distributions and do a lot of other interesting things. But it also provides access to that crypto native capital for the insurers. So there's a bunch of different benefits when you start talking just about like tokenized real world assets beyond the crypto currencies.
Yeah, got you. And Rob, you do a lot with the tokenization of assets. Can you give us some examples about like what happens in TradFi and what problems like the DeFi solutions are coming in to solve and why it's better?
Yeah, certainly in TradFi, in the financial institutions, they were very interested in the early days of DeFi because and it was spoken about at board level within financial institutions, because they saw potentially the issue of everything just going real time, real-time settlement. Mentioned earlier that across multiple processes, whether that's buying equities on a stock exchange, settling, moving money around between bank accounts, payment and remittance, all these types of services, even insurance markets, there are delays in a lot of the processes, and those delays are put in place for checks and balances and other types of reasons. But if decentralized finance offers that all of those times to be shrinked into real-time settlement, and real-time settlement could save financial institutions literally hundreds of billions, across the world. So there's obviously a great interest in this, but the challenge is how do they engage, and I think we'll talk about that later.
Rob, I know you wanted to talk a little bit about like speeding up money and how it then allowed kind of more transactions to occur and more capital to flow into the system. You got some sort of views on why tokenization of assets is a good thing, a bad thing, a positive thing for the industry?
Yeah, I mean, if you go back to the original question of this talk, how is traditional finance embracing DeFi, then, as you say, it's looking at new ways of doing things, new product offerings, which, banks are now starting to look to do themselves for ETFs. So there's a product level of innovation, that's being carried over. Then you've obviously got investment from asset managers and banks into exchanges, into other providers, stablecoin providers, and all sorts. So you're seeing money coming in, and I guess it's coming in at a time when the industry is in a bear market. So it's opportunistically coming in at the right time, and then people are getting quite excited, going, that means that this crypto coin will go up, this crypto coin will go up as a result of BlackRock being invested. You're like, well, BlackRock is not going to put 7 trillion of its assets under management into crypto. Yeah, it's not going to do that. So don't get ahead of yourself. But I think there's two ways of looking at traditional finance embracing, using inverted commas, embracing decentralization. One is at a technological level, what can it take to then apply to what it does and do it better, in which case it will take that and then doesn't really need this industry anymore. And then there's also the other way, which is, well, how can I can't remember the name of it, the UK exchange is downstairs, but they've taken some money from Aberdeen Asset Management. And so they want
Arjax.
Yes, thanks. Okay, them. And so they want, they've got the regulatory situation that they've got here means that Aberdeen Asset Management is clearly trying to cater to the people that want to do that. And I suppose if you go back traditional finance as an industry, what it saw in 19, 20, 21, 22 is, I guess a lot of people just don't trust banks, asset managers, hedge funds, PE firms, and they want to do it outside of that, right? So and there are reasons for that. It's not just because of where they're from, Nigeria, India, wherever. But it's about saying I don't really want my money to be managed by Goldman Sachs, and I got nothing against Goldman Sachs, but I'm just one human being. So I don't know to what extent that's useful, but trying to bring it to the question, it works both ways. This embracing nature, and I think the decentralized part, which is only, if you looked at crypto markets, is worth just over $1 trillion, has a long way to go before it's like, well, we're on par with traditional finance. You're like, well, no, you're not. There's 146 trillion of assets under management in asset managers. So you got some way to go before you're going to be anywhere near that.
Yeah, right. I mean, you make a good point there, and it's probably worth reiterating that, like, embracing DeFi doesn't mean going out and buying a bunch of altcoins on Binance, right? It means looking at parts of your infrastructure and parts of the service offerings that you have as a traditional finance firm and picking, like almost cherry picking the things that are innovative and will save you money or make your firm more efficient. So beforehand, we were talking about examples like KYC tokens and, or actually from the panel previous to this one, a good example of tokenizing assets is maybe stable coins. I don't know if the panel's got some comments about the embracing of stable coins specifically, and where we think that will go in the next kind of year or so. Chuck that one open to everybody.
I think maybe there's a point there just in terms of interest rates, and do you want to? You look at someone like USDC, or you could give any example really of something that is a stable coin, but they're doing pretty well out of the interest rates right now, and so I think that lends itself again to someone innovating in that space to give yield where you're getting cut off from some of that just by being in fiat, right? So there's tensions both ways. There's like the use of stable coins. There's huge use cases for stable coins, but also like whilst they are a bridge to the fiat world. So how do we deal with that kind of thing?
Maybe the next question, right? Like the bridge between what firms have traditionally done in finance. You go straight to your bank and you put your money, you give it to them, and they'll lend it to somebody else, and then maybe you'll get some returns on it. Versus chucking a bunch of stable coins in an Ethereum contract and getting paid out, in a similar way. One's a lot more transparent, but it does raise some big questions for firms with their own regulatory requirements and compliance frameworks. How do they get access to these newfangled instruments? And maybe we can just touch a little bit on some of the problems that may need to be solved before we get a sort of more mass adoption. So, permissioned versus permissionless chains, know your customer, know your counterparty, and those sorts of things. We spoke a little bit on the panel earlier about tax. Maybe we don't need to dip into that too much, but security, transparency, privacy, and so on. I don't know, T, have you got any?
Yeah, I think just like it's a nice sort of segue from my sort of previous thoughts. So something that's worked, and you've rightly handed to the DeFi side, is it's an infrastructure play, where DeFi is all about sort of information arbitrage. It's not based in the traditional system where the handhold relationships, where you don't know what are the deals that are sort of being made in the room and who's trading what, et cetera, et cetera. Whereas in the DeFi space, it's infrastructure. Everybody has access to the same data. And that makes the system all so very sort of efficient. Something that's not worked very well in the DeFi space, it's not really scaled. So you haven't had the option markets, the derivative markets sort of come online, and as a result, or for the lack of even KYC, there's been a lack of sort of lending markets where if I lend to this wallet, how do I know I'm going to get my claim back in the future? And that's not really sort of grown. And what this means, I think, where I sort of see that going is it's going to give way to credit rating sort of reputation scoring systems, which can happen at a DeFi infrastructure level, but then we will begin to see traditional sort of banking infrastructure systems coming on board where they see the benefit of this sort of infrastructure, whereby if they want to increase or compete against other institutions, and they say we can provide to our collective of institutions the same access to data, or to access to the same data. That's more of a competitive opportunity than sort of closed fence systems. One good example of this, I think, would be, for example, we see JP Morgan they built a private instance on Ethereum. And you can transfer CBDCs, wholesale banking, or tokens. I think the first use case of that is happening in Bahrain using the JPM token. And they had a cross-border sort of example between Thailand and Singapore, where coming back to this whole money tree, they can go up and down that system. So that is an example of a permissioned private permissioned blockchain. Whether that's sustainable in the long term or not is a question. It is still sort of open to privy, but I'll stop there. I can natter on for ages.
Does look suspiciously like bits of infrastructure that already exist in TradFi with a different name on it. Like if you write AI, maybe your stock price will go up 20%. So Rob, you were going to chip in?
No, just going to say that what's interesting is some of the institutions now are starting to look at and see how they could use public blockchain networks. The issues with private chains and private chain infrastructure is there's a lot of cost to that, there's security issues around that, and then there's also the issue of when it's permissioned, obviously, entry points into it, and then transferability. There's not much transferability. So I would say that institutions are starting to struggle with this, but one of the questions they ask, and they certainly they ask us, is if we choose to use a public blockchain, we have to ensure that it's going to be around for at least 15 years. And okay, this industry, unfortunately, isn't that long. And if we look at the next 15 years, as we've seen with companies that have started and then failed, look like good prospects, not survived already, which are going to be the strong blockchain protocols that survive for the next 15 years, and can you really build solutions that last a long time, that plug into those institutions, and they don't have to move across to another chain or some other catastrophic type solution.
Yeah, fair. I mean, maybe that's a good place to sort of delve into as well. Is when all four of you are going in and talking to traditional finance firms about adoption of either wholesale, just move your business onto DeFi. Maybe that doesn't happen so often, but adopting small pieces of DeFi technology in their existing businesses. Where are you seeing the main bits of pushback? Because a lot of things tend to sound like the easy excuses rather than people stepping forward and taking risks and pushing their businesses onto the next stage. That's probably one of them. Is this going to be around in 15 years' time? What do they do? Wait 14 years and then adopt it, or what happens? And are there any other sort of good examples that you've seen where people point out and say, I can't do DeFi because of that thing?
So I think an easy example is a lot of firms just don't want to hold crypto on their balance sheet. So when you talk to them about not necessarily even implementing some sort of infrastructure, like maybe that's not their business, maybe they sit somewhere different in the value chain, and they just want to take, I don't know, say they want to take commission for their services in in some sort of crypto. That can be challenging for them, and big companies, it can take a while for the wheels to turn for that to.
Do those tend to be like technical limitations or regulatory or tax?
Definitely regulatory.
Yeah, because there's some financial accounting things that really stop people from doing this. Like, I took $50 from you, it's in USDC, it's sitting on my balance sheet, but now I have to have another $50 over here to cover that risk. It seems a bit silly. But it's a very good example. Does anyone come across like security-related issues?
No, I think from the education side, funnily enough, it's usually an education or a knowledge play more than anything. So I've spent a lot of time sort of post 2017 to 2020, just before COVID, working on a lot of like CBDC stuff with sort of 3 or 4 central banks around the world. And that was usually a case of we'd spend 6 to 9 months educating a central bank or their staff on the technology, the opportunities, and then suddenly they'd have this aha moment of, okay, brilliant, I kind of get what all this smart contract money program.
Burst into you, but
yeah.
I mean, isn't that the problem, that this industry is so complicated that if it takes you 6 to 9 months to understand it, you're just going to move on, yeah?
Well, I don't think
you've got to make things so much more easier. People understand what a retail bank is. They go in for it for a mortgage, for a loan, and maybe to buy shares. If in the UK, people tend to buy it through Hargreaves Lansdown or Vanguard, it's the same international. You've got to make it so much easier for people to do stuff. Right, so with your company, Alex, insurance, you're like, okay, that's cool, but you said to me yesterday that you only typically work with certain type of client types who have got a certain value, right? So it's not for retail customers. So I think to achieve for decentralized firms to break into the traditional side, you've got to make it so much easier for people to do this stuff. Like if it takes you 20 minutes to sell some crypto, to move or to get out of the trade, I mean, it's just too long.
I'd say most emergent technologies work like that as well. If you wind back 20 years and point out to somebody what an internet website looks like, they look at you like, I don't know what that is. And look, it all went bust anyway, and therefore, the world only needs 6 computers. I think some of that stuff takes some time, and you've got to remove that, especially at the institutional level. I think removing the career risk piece is really important. Like the Elon chucking Bitcoin on Tesla's balance sheet meant that the other 499 S&P 500 company boardrooms, suddenly no one's getting laughed at and fired for mentioning the word Bitcoin in it. I find that might have flipped back the other way now, but that sort of market leader stepping out in front and showing everybody that it's not scary anymore, you're not going to get fired for looking at this. I think that's probably quite a good starter point. Then all the excuses turn into problem-solving requirements rather than, this looks too hard, I'll just walk away from it.
Yeah, I think that's fair, and it's also crypto is an interesting one in that lots of incumbents don't really have that incumbent advantage for the reason around regulation. So there's a lot of sort of contagion and risk if they do something wrong, in the regulator's eyes. Then that risks the rest of their business as well.
Yeah, it does. But I'd counter that one as well by saying if you were to pick a group of people or an industry that are very good at regulatory risk and working out how to manage it properly, it's the traditional finance industry. Like, they're literally the experts at this. Yeah, cool. Okay, so maybe I'll flip the question around a little bit and piggyback off of that last comment. What do the building blocks look like? What are the steps towards some sort of major large-scale adoption in TradFi? Like, what things go first, and then where does it end up?
So, I mean, it's a little bit kind of doom and gloom, but we've said so far. But
I'll pass on to the next person then.
But what I'd say from a positive angle, I think that there are some significant tests that have been done by financial institutions with tokenized bonds and repos. There's been all kinds of platforms being built or solutions being built, but they're only really being test phase. I've been fortunate enough to talk to the HM Treasury here, who is in charge of secondary legislation, and they are engaging with traditional finance right now about how they scale those solutions. And that's where the real efficiency comes into traditional finance. So it's not necessarily jumping onto a DeFi platform, but this is actually about how do they use the technology to scale and bring these efficiencies into the financial institutions, but regulation has to be part of that. They won't do that without regulatory clarity.
I agree. It's the regulation piece, and that's because otherwise there's a huge coordination problem. So the POCs at the moment are super interesting because they are out in public. They're not sort of the unwanted thing in the corner that they don't talk about. They're doing things. Was it UBS are doing a public something on Ethereum now. There's lots of interesting POCs that you can see out in the wild, and that's if they're using public permissionless blockchains. There's an argument there that it's easier to coordinate around those rather than these little groups trying to coordinate it otherwise.
Yeah, I think it's a false narrative that institutions aren't doing a lot. As I mentioned, JP Morgan have actively building the space. You got HSBC already running their global trade finance sort of network, trillions of dollars a year on a private Ethereum instance. And then you've got all the large investment banks sort of running or have set up custody, sort of digital asset custody solutions. So when you look at the signaling of the institutional player in this space, they're all getting primed to do that. And yes, the regulatory piece will sort of enable some of that to happen. I guess where this whole permissionless versus permission comes in from a DeFi perspective is the whole C-DeFi kind of opportunity where can we build trusted front ends using DeFi infrastructure? Not necessarily the crypto asset side, but it builds sort of transparency, trust, accountability, all the good stuff of that blockchain brings, where we can just build nice GUIs on top of these DeFi sort of platforms. I think that's where we're going to see a lot of innovation and growth kind of happening there, and then it's going to be a whole phase of that SaaS, FinTech 2.0 sort of era where you're going to see these service-built service
So like CeFi execution platforms and DeFi custody platforms, or some break that looks a little bit like that.
Yeah, definitely.
Cool. Rob?
I want to borrow from a sort of slightly separate area, looking probably more at the macro level, and just look at the reasons for maybe some of the drivers in that. I mean, you've got Chinese economy not doing very well. The US is effectively bust. I mean, if you have to have a shutdown every 6 weeks, you're bust. Yeah, I mean, don't understand how people can't see that. I mean, 33 trillion in debt and rising every week. I mean, the US has no plan to pay down its debt, and at some point it's going to go wrong, right? And Germany's obviously struggling as well. So I think I don't want to be like a doomsayer, but there is a case to think, okay, if we need to move out of traditional assets because we're worried about large economies, then I think you could see a slightly faster adoption on that level. I'm not predicting it. I'm just saying that there is a case for that. If you see big economies around the world really struggling, especially Germany, China, and the US, then I think that might expedite people going, yeah, we need to do more.
Pushing people away
and people
sovereign
moving,
debt.
yeah, and people moving into different asset classes, right? Cool. You know, you're gonna leave the dollar, aren't you, right?
Yeah, and all the old people dying and all the young people coming in and building new stuff. I think it's pretty good catalyst for most industries.
Just to add to that, actually, there are a couple of sovereigns I know looking to tokenize sovereign debt. So that's going to be quite a lot of innovation to try and actually just bring liquidity. Because imagine if you're issuing a government bond and liquidity is drying up, they're thinking tokenization is going to fix it. I'm not sure it will, but wider liquidity for their access to government debt for projects within their countries. This could be a real innovation using this technology.
Okay, we've got a minute and a bit left. I'll just finish off with one question. Like, favorite DeFi style protocol that you think's worth mentioning on here? You're not allowed to talk your own book.
Not my own book, not invested, but I like, there's a regulated DeFi exchange based in Germany called Small Markets. I like them a lot.
So what we were just talking about, the sort of front end, back end split thing. Cool. Alex?
It's kind of analogous to what we're doing within insurance with loans. I quite like Maple Finance.
Borrowing off of sort of anonymous style people through one big pool with some wrappers around it.
The tokenized pool style thing.
Yeah, no, very good. Use them.
Don't want to be biased here, so got a few that's going to the back of my mind. Yeah, I'd probably choose Maple at the moment, or Aave is probably a good one. I think there's a lot of opportunities there, and probably say Centrifuge on the real world asset side is showing a lot of hopes.
Coming from an exchange, I don't really talk about a particular project because I don't think it's right. But there's a really cool project that I saw in Denmark recently, and it's basically a real estate investment trust, but through tokenization. And they're buying like small houses and then looking to rent them at a cheaper rate so that people in Denmark can actually afford to live somewhere. Right. So that's pretty cool.
Cool. So like tokenized assets, tokenized debt, and some exchange stuff. I think the market data side of things is cool as well, like protocols like Pith and Link and so on, where you get real world things and bung them on chain for everybody to use. So there's I think the reason for that question is it shows that you don't need to go all in. You don't need to move a traditional finance company and industry all onto DeFi, but you can adopt these little bits for different parts of your business. Superb. Thank you very much, everybody up here. And yeah, thanks for listening to us for the last 25 minutes.
Thanks very much.
Great.
Thank you.